Hello and welcome. Today we're talking about investment accounts, specifically your retirement accounts, tax-free savings accounts, non-registered accounts. So before you can get to understanding or knowing which investment you want to put your money into, so stocks, bonds, mutual funds, ETFs, before you can even get to that, you have to know which investment account you want to invest under. So think of it as an umbrella. And they all have different attributes, and you want to know which one is best for you. And that can be mind numbing. There's so much information and it's generic, and you want someone to tell you which one is best for you because it's not a one size fits all. And there's so much hype in the media when you hear about them, and it can become really confusing. So I want to demystify some of that today and go over with you the most popular types of accounts and when you would use them so that you can make the decision that's best for you, because you truly are the best person to make that decision. You've got the most vested interest in it. So my name is Irene Byrne, and I'm here today to share with you some of this information. So let's see if I can make this a little bit bigger. And I'm still in the picture, so that's good. And moving over, I'm going to move myself over here. So four types of investment accounts, main types of personal investing accounts: the RSP, so your registered retirement savings plan; the TFSA, tax-free savings account; RESP, we're not going to talk too much about the registered education savings plan today, and I will explain why at the end, and the non-registered account, which you hear very little about. So those are the four that we're going to cover today. Let's begin with the RSP. So that's probably the most well-known. The RRSP, RSP, it's the same thing. It's been promoted as the place you want to put your money. And it gets really confusing for people to know the difference between an umbrella, so an investment account like an RSP, and then the investments actually within the account. So where you've put your money into stocks, like I said, ETFs, where you've chosen to invest the money under this umbrella. When is an RSP right for you? So some of the attributes of the RSP, or retirement savings plan, is that it's a method of tax deferral. So you can invest before tax dollars. Let me give you a simple example. Let's say you make $100 and you're in a 30% tax bracket. You could invest after tax, you could invest $70, right? $30 went to tax, you've got $70 left over. So you would be investing with $70. With the RSP, you get to invest with before tax dollars. So you could invest the whole $100. The advantage is that you now have more money in your investment account. Any growth on that money is tax deferred. So it will grow tax-free until you pull it out of the account. And here's where it's not so attractive. This is the part that people don't like so much. I worked as an accountant for over 25 years, a public accountant, and what I discovered is that people were very happy with the tax savings on the way in and very unhappy with the tax bill on the way out, to the point that you will hear people saying, all my money goes to tax when it comes out of my RSP. Like, it just seems like more than a fair share is going there. Now, here's a couple of things that you want to keep in mind, is that most of us will not be in a lower tax bracket when we retire. We are most likely going to be in the same tax bracket or higher. So we could be in the same tax bracket because of other pensions, Canada pension, old age security, maybe we have another company pension, and then we have to withdraw from our RSP on top of it, pushing us into the next bracket. The other drawback to an RSP is that every dollar that comes out is taxed. So if $5 come out, you're taxed on $5 in your tax bracket. There's no preferential tax treatment for earning investments through capital gains or dividends. So none of that applies. You are taxed dollar for dollar as if it's income. So I recommend that people not use this strategy or think carefully about using this strategy unless they're in a 50% tax bracket. If you're in a 50% tax bracket, then yes, it makes sense. You make $100, you would pay $50 in tax and have $50 left over. You might as well put the whole $100 in, knowing that you will be in a 50% tax bracket when you retire anyways, so that or lower. So you won't be in a higher than 50% probably. So that would make the most sense. When you're in a 20, 30, 37% tax bracket, you really have to think about whether this is right for you. What happens when you withdraw from an RSP is they take some tax at source, but then when it comes to filing your tax return, you are then taxed correctly, if that would be the better word for it. So usually it results in a tax bill. So you paid tax and then you pay more tax. And although it may not exceed your tax limit, it feels like more. People really don't like that part. So using an RSP is one way to invest, but you would need to decide based on some of this criteria if it's the best one for you. Your other choice, so compare and contrast, your other choice would be the tax-free savings account. Now, this is a newer account, so it came into being long after the RSP was established. The tax-free savings account is a very misleading name. So initially when it came out, people thought that that was for savings, but you can invest in anything under the tax-free, under the TFSA umbrella. You can invest in all the same stocks, bonds, mutual funds, ETFs that you could in an RSP. There's no difference there. The differences are that you're investing with after-tax dollars. So when we use that example of making $100 and paying $30 in income tax, you would be investing the $70 you had left. So you'd be starting with a smaller amount of money, but all the growth is tax-free. And it's tax-free forever. So you can pull it out at any time and there's no tax. So any money that leaves the TFSA is tax-free because the initial investment amount was already taxed. So there's no tax on that. And the growth is tax-free. Everyone can contribute the same amount. So in an RSP, you can only contribute based on your earned income. So there are limits to that. But everybody can contribute the same amount. So for 2019, you can't see it really here let me move me out of here. $6,000, I believe, was the limit for 2019. So everybody could put $6,000 into a TFSA. Contributions are cumulative. So what that means is from the time you were old enough to contribute to a TFSA to date, you can contribute up to that amount. So if you have never put any money into your TFSA, you could put the whole amount in today if you had the money. You can take the profit out anytime, and you can also take your money out and put it back in. There's some restrictions around that, but that's different from an RSP. So in an RSP, I'm just going to move myself back up here. In an RSP, when you take money out, that contribution room is gone. You can't recontribute that same money. Here, it's a little bit different. So I recommend everybody start with the tax-free savings account and max this out. If you're in a 50% tax bracket and you want to invest in your RSP as a tax strategy, then you'll work with the two. And keep in mind that if you invest into your TFSA to start with and then decide that you would rather have some or all of that money into your RSP, you can just move it. You can move it over to the RSP with no tax implications whatsoever. So the pros of the tax-free savings account are that it's tax-free and it's flexible around contribution room. The con is that you're investing less money because you're investing after tax dollars. Those are some of the biggest differences between the two. What comes next? The non-registered account. Once you've maxed out your TFSA, if the RSP isn't right for you, or if you're fortunate enough to have maxed your TFSA and your RSP, then you're going to go non-registered. So what does that mean? It means you're investing not under any umbrella. You're just investing and paying the taxes each year on the money that you make. One of the nice things about a non-registered account is that there's preferential tax treatment for dividends and capital gains, which you will see. Yep, there's the other half of it. Currently, when you earn income through a capital gain, half of it's tax-free. So you don't get that in an RSP. If you make $100 as a capital gain, coming out of an RSP, you're taxed on the whole 100. In a non-registered account, you'd be taxed on 50 or half of it. And dividends get preferential tax treatment too. Capital gains are only taxed on deemed disposition. So you have to sell, you have to convert from the investment back to cash to have a trigger a capital gain. I recommend using the non-registered when your TFSA is maxed for one, and then depending on what you decide on your RSP. Definitely the advantage of the non-registered are the tax advantages around dividends and capital gains. You are investing, though, in after-tax dollars. So the difference between this and the RSP, I guess just to cover it again, is that when I make money with dividends and capital gains under the RSP umbrella, it doesn't matter that they're dividends or capital gains. Everything is taxed dollar for dollar like income. So you'll be taxed more on the money leaving the RSP than you would in a non-registered. But it's before tax dollars or after tax dollars and tax deferral. Some of the biggest hits that people notice is when they're into retirement and they have a lot of money in their RSP and they realize that when they pass on, not their spouse, so it can transfer to the spouse, but after that, if you want your RSP money to go to your kids, half of it's going to go to the government, right? It's going to be at a 50% tax bracket. And then people are unhappy about that. I've seen people accumulate, $1 million in their RSP and then realizing that 500,000, give or take, but 500,000 is going to go to the government and their heirs are going to be left with 500,000, not $1 million. So some careful estate planning needed. The fourth one is the RESP, the Registered Education Savings Plan. So I'm not going to say much about this here. This is a little bit of my own personal opinion. Everybody as a parent wants to pay for their child's education or have money set up for that. And of course, people who promote the RSP definitely want us to have money for education. But I believe good financial advice is to protect yourself first. The best thing you can do for your kids is for them not to have to look after you later in life. So your pension, your savings, your retirement, that should come first, then the RESP. You can always, withdraw from your TFSA to pay for their education. Lots of options that can come later in life. So I would definitely consider the pension more important than the RESP. So that's all I'm really going to say about that. I hope that helps clear up some of the differences between the different investment accounts so that you can choose the best one for you. Move myself over here. Thank you for listening, and I'll see you next time.